Stevens here once again with Mortgage Shots and the National Real Estate Post, representative of the Loan Factory, more specifically CB Loans Team. If you'd like to learn more about CB Loans Team and what we're doing, which is so drastically different than every other mortgage company in the country, I would love to tell you. And I'm not kidding about that. I want to start with something right now. We're going to talk about a bunch of stuff. Crypto homes, kind of crazy. It's the latest in a multitude of desperate moves that are being made by all of our policymakers right now. Here's a spoiler alert. The decisions they're making are going to end like every other decision they've made. Not good. I don't understand these decisions. I swear we could get better people in charge. We're also going to be talking about a multitude of different things, so just bear with me, stick in there, and give me any questions, comments, anything you have, pop it in and let me know. That would be super duper helpful for me. Housing's a real problem now. Job growth at the high end has stalled. Article summary. Housing market demand is constrained by zero growth at high-end jobs despite mortgage incentives. We're going to talk about mortgage incentives and why they are a bad idea. I mean a bad idea. And a migration shift. So what's happening right now is employment is just dead in the water. It's not going anywhere. Mining is down. Construction mildly up. Manufacturing down, wholesale trade dead in the water. All of this stuff right here is dead in the water. Private education and health services. Private education because people are sick of our public schools right now. They don't want to go because they don't like what's being taught, and I think that shows. So private education and health services. Government is doing pretty good. That's not really surprising. Retail's dead in the water. Everything's dead in the water here. But here's the key here. These are all high-end jobs. These are jobs that pay. And I started thinking about this a little bit here. AI is going to have a significant impact on housing and on employment. AI is going to take a lot of jobs over. AI is currently taking a lot of jobs over. And the jobs that AI are going to take specifically are the ones that are null and void of any emotional involvement or requirement in order to have that job. And real estate lending, oh boy, is that a big one emotionally. It really honestly is. It's going to take those non-emotional, non-empathetic jobs, kind of math-based and science-based jobs. AI is going to be taking a lot of high-end jobs away. High-end jobs are people who make money. People who make money are people who buy houses, which means our potential pool for buyers going forward is going to be mitigated courtesy of AI. The efficiencies that AI are going to bring to businesses are going to lead to a smaller workforce, larger unemployed folks, larger numbers of unemployed folks, and fewer clients to buy houses and get loans. We know this to be the case. This isn't going to be something that's happening on the horizon. This is something that is happening to us right now. Let's jump into the meat and bones of what we're going to talk about here today. Is the market turning? Well, let's just start with this one. 875,000 mortgage holders now owe more on their homes than their homes are worth, the highest rate in 3 years, and this is according to a new report from Intercontinental Exchange. That number is going to go up and go up drastically as property values continue to decline and home sellers and home owners hold on to their prices. These numbers are going to go up, and what we learned back in 2008, 9, and 10 is that when you're underwater, it doesn't matter if you have an agency loan, that being your conventional loans, a VA loan, a FHA loan, a subprime loan, a non-QM loan, a DSCR loan. It doesn't matter the damn loan you have. If you get buried too far upside down, what we know from every mortgage holder, from the 800 credit scores down to the 400 credit scores, is this simple fact. They walk. And we're seeing these numbers increase, and this is putting more added pressure on foreclosures, pre-foreclosures, 30, 60, and 90-day lates. All right. This is what I want to get into here, guys. Builders' cheap mortgages are a bad deal for homeowners. I cannot believe I have not said this before now, but this is very, very important. You're going to have clients right now who are going to go to new home builders and they're going to say, well, Brian, I'd like to go with you, but you're going to offer me a 5 3/4 rate, and they're going to offer me a 1 rate or a 2 rate. I want the 1 rate or the 2 rate because superficially, that sounds better, doesn't it? The problem is that builders have an incentive to lower the rate, not lower the price. New home builders are renting properties because they can't sell them. They can't sell them for what they need to get from them. We are starting to see 1% and 2% mortgages because they can't sell their properties. Here's the problem that the builder is not really coming to terms with, is that all those houses are going to sell $50,000 less anyways. Probably. There might be a sucker here or there, but probably. What we're discovering is if you take the higher sales price and the lower interest rate, you're walking into a house that's upside down on day one. It's kind of like buying a Corvette. Buying a house in 1985 versus buying a house today. Now, this does, to a certain extent, take inflation into consideration. The median home price, the median house income. Back with our baby boomers in the 50s and 60s, the median income was $23,620 with a sales price of $83,000, 2, 4, 6, 8, or about 3.5 times what your annual salary is. Today, $74,000 is what you're making, $468,000 median sales price for a house. 5 goes into 7, 35, 642, 749. It is 6.5 times your annual salary to buy a house for a millennial, where it was 3.5 times just a few short generations ago for people like my mom and dad. Our income has gone up. Yes, property values have gone up, but property values have literally outpaced our income by twofold, meaning it is twice as hard today to buy a house as it was back in the 1960s. Doesn't matter where inflation is, this is something that we're going to need to overcome. That's why the 1% interest rates might sound good, especially on new homes, but don't be a fool and take that. U.S. credit card delinquency balances continue to tick higher. Right now, we are sitting at about 12.5% delinquency rates. That's a big number. That's over 1 in 10 right now who have credit cards are behind on their balances. Now, for those people 1 in 10 who own a house, what do you think is going to happen next? That mortgage is the next one to fall. There's going to be a lot of listings, realtors. There's going to be a lot of listings. And of those listings, you're going to want to find those who are delinquent on their delinquent on their credit cards. The Trump administration wants to allow crypto-backed mortgages. Desperation? Do I hear desperation once again? Strike that. This isn't actually terribly desperate. I think it's a little bit irrational because of the nature of cryptocurrencies going up and down in values. But the thing is, you're not necessarily going to be able to buy a house with your cryptocurrency unless you turn it into United States currency. But what they do want to do is they want the FHFA to go out there and use your crypto assets to have it for your reserves that you need. So if you have crypto, depending on what it's trading for at the time, you could go ahead and use that for necessary reserves or compensating factors in order to get your loan approved. This could be a relatively big difference. If it's about reserves, then it makes sense to me. If you're actually using cryptocurrencies to buy a house, maybe not. It's no secret that buying a house is expensive. The average sales price for a United States house is hovering around $400,000. We just showed you it's quite a bit higher than that since 2021. And this is according to the St. Louis Federal Reserve. Most home buyers looking to cover the costs turn to mortgage lenders who pore over financial details like salaries, bank balances, retirement accounts to determine how risky it is to lend money to you. That review process has typically excluded crypto assets, but for the roughly 15% of Americans who invest in digital assets, this soon could be changing because in June, a directive was issued by the FHFA and it ordered mortgagee giants Fannie and Freddie to develop proposals to consider crypto as an asset in single-family home risk assessment. Probably not a bad idea. And we're going to need to get more people who are qualified for houses because we are about to see significantly more inventory coming on board courtesy of some of these foreclosures. It's because we're seeing a softening of the market. So what are the softest markets right now where you could probably get a pretty damn good deal on a house? Well, it's going to go this: Champaign, Illinois, Florida, Texas, Hawaii. Strangely, California's not on that. Florida is all over the board. Why is Florida all over the board right now? Because condos are a pain in the ass down there. New foreclosures jumped 20% in October, a sign of more distress in the housing market. 20% in October. Guys, we are picking up at an exponential rate right now. The market in December and January is going to be unrecognizable from the market we're currently looking at in November. All I see is opportunity. Foreclosure starts, which are the initial phase of the process, rose 6% for the month and were 20% higher than a year before. Completed foreclosures, the final phase, were up 32% year over year. Man, that is a massive number. We are now officially off the mat and we are starting to rise. This number is going to go through the freaking roof. Let's bring back the implodometer. Who says we do that? Florida, South Carolina, and Illinois led the nation in state foreclosure filings. So as a loan officer or real estate agent, go out there, get a little bit more creative. This market is going to open up for you. All the news feeds that you're going to see are going to tell you how bad everything is right now. And I'm telling you, it ain't bad.